Well, GDP rose at a 1.1% annual pace in the first quarter as resilient consumers continued to increase spending. On the flip side, we had business investment waning, we had inventories waning, and all of that sort of weighing on those GDP numbers, which, by the way, compared with the 1.9% increase in GDP that economists had been projecting. So still seeing 3 straight quarters of growth after the 2-quarter contraction we saw in the beginning of last year. But, you know, if we're sort of in this uneasy place where we have slowing economic growth, persistent inflation, it occurs to me, I haven't said the word stagflation out loud in a little while here, but I wonder if this GDP report is a little stagflationary.
All right, count 2 on the stagflation mentions during today's show. But even as you think about what the employment backdrop looks like, it's still going to come back to where consumers continue to find strength, at least right now. And if the consumers are looking back to the employment market and the labor market, strong job market, you've got wages that have still risen. So all that considered, a consumer right now, even if you are focusing so much more on where you're just able to spend necessities and then reprioritizing where the discretionary spend is going, I think that's what's amazingly critical, because much of the spending that consumers are going to do is going to be on necessities anyway. So now it's just the shifting of where that discretionary spending has gone. A lot of it, if you ask the travel companies, it's going into the experiential economy and to the services side that we've continued to see sustained as well. And so that all factored into the broader kind of economic slowdown that had been anticipated, and that, of course, if we're looking at the quarter over quarters, still is taking place, but we're still growing at this point in time, too.
Yes. And that personal consumption number, the 3.7% increase, by the way, is inflation adjusted, but that shows that people are still spending. And then the price index part of GDP, 4.0% headline, 4.9% the PCE, core PCE quarter over quarter, which, as we know, is the Fed's preferred gauge of inflation. What's interesting is both of those were higher than estimates, but you would think after all of the first quarter hotter than estimated inflation numbers we got, you would have thought that economists would have brought that up even more. But even, coming in hotter than that still is something that I think bears watching. One more quick note as we talk about GDP is that this is the first read, so it will be revised. We get 4 or 5 reads when all is said, 4 reads, I think, when all is said and done. And then, by the way, we also got Caterpillar numbers, and I mentioned Caterpillar because it's seen as an economic bellwether, and those numbers look pretty good. We saw revenue up by about 17%. The company gets just over half of its revenue in North America, so it's sort of a good proxy for what's happening here. It seems like the shares are down a little bit as investors are asking questions about construction demand going forward. Obviously, that's where they're one of the places that their equipment is used.
Yeah, absolutely. And on the margin front, too, I thought that was particularly interesting. They had a strong increase year over year, at least, operating profit margin, 21.1% for the first quarter. You compare that with the 13.7% that they saw during the first quarter last year. I think in the demand environment, investors might also be paying attention to is where, even as they're saying that, this is not a sustainable period of demand that they're seeing, might even be pointing to some of the regions around the world. Greater China is one of the areas that investors and analysts keep a close eye on. And even as you're seeing the reopening and the restart of some construction projects in China more broadly kind of being a beneficiary for a company like Caterpillar, it's a question, to the investor's point, of how long can that sustain itself over an extended period of time.
Especially as we see these GDP numbers slowing down.
Yeah, exactly.